In the quiet hours before the markets opened, a single decision from Washington sent a wave of tension across Wall Street and Main Street alike. At the center of that tension stood Jerome Powell, the calm and careful chair of the Federal Reserve, facing the most delicate rate call of his career. For months, investors, homeowners, students, and business owners had waited for relief, hoping that falling inflation would finally unlock lower borrowing costs. Instead, the Fed held rates steady again, and in that pause, many heard a warning louder than any rate hike. The message was subtle, but the meaning was sharp, because trouble for borrowers was no longer a future threat, it was a present reality. To understand why, we must travel back to 2020, when the world shut down, markets crashed, and the Federal Reserve slashed interest rates to near zero to save the economy. That emergency move fueled a historic boom, lifting companies like Apple, Amazon, and Tesla, while cheap loans flooded housing, cars, startups, and stock trading. By 2021, money was easy, optimism was high, and inflation seemed like a distant memory from another generation. But in 2022, inflation roared back with force, reaching levels America had not seen in more than 40 years. Gas prices surged, grocery bills jumped, rent exploded, and suddenly the Fed's rescue plan turned into a battle plan. Jerome Powell launched the fastest rate hiking cycle since the era of Paul Volcker in the 1980s, pushing interest rates from near zero to over 5% in just 18 months. Markets trembled, tech stocks crashed, banks like Silicon Valley Bank collapsed, and millions of borrowers felt the pressure rising. Yet inflation slowly began to cool, raising hopes that rate cuts would soon follow. By late 2024, analysts across CNBC, Bloomberg, and the Wall Street Journal predicted a smooth path toward easier money. Traders priced in cuts, homeowners dreamed of refinancing, and companies planned expansions based on cheaper credit. Then came the Fed's latest meeting, and with it a decision that changed the mood entirely. The rate stayed high, and Powell's words carried a caution that felt heavier than before. He spoke of stubborn inflation, tight labor markets, and lingering risks, signaling that the fight was not over. Behind that calm tone, the reality was harsh, because every month of high rates tightens the financial grip on American households. Mortgage payments remained elevated, keeping first-time buyers locked out of the housing market. Auto loans stayed expensive, pushing average monthly payments to record levels. Credit card balances crossed $1 trillion, with interest rates above 20%, draining family budgets silently but steadily. Student loan payments returned after pandemic pauses, colliding with rising rents and everyday expenses. Small businesses, the backbone of the American economy, struggled to secure affordable financing, slowing hiring and investment. This was not just a technical policy decision, it was a human story unfolding in real time. In suburban Ohio, a young couple postponed buying their first home because their monthly payment would have doubled. In California, a startup founder delayed hiring engineers, uncertain whether future cash flow could support higher interest costs. In Texas, a truck driver watched his credit card balance grow as fuel and repair costs climbed. Each story traced back to the same source, a rate environment that refused to soften. For Wall Street, the reaction was swift and emotional. Stocks swung wildly, bond yields climbed, and volatility returned to trading floors. Companies that rely heavily on borrowing, like real estate developers and small banks, felt immediate pressure. Even giants like Microsoft and Google adjusted their investment strategies, favoring efficiency over aggressive expansion. Behind the scenes, policymakers debated a difficult truth because cutting rates too early could reignite inflation, while holding too long could choke economic growth. The Fed's challenge became a balancing act between stability and survival. History offered powerful lessons from the 1970s inflation spiral to the 2008 financial crisis, showing that mistakes in timing can reshape generations. Powell understood this weight, knowing that every sentence he spoke could move trillions of dollars and millions of lives. As months passed, economic data delivered mixed signals. Job growth remained strong, wages climbed, and consumer spending stayed resilient, suggesting the economy could handle higher rates. Yet beneath the surface, cracks appeared. Delinquencies on auto loans ticked upward. Credit card defaults edged higher. Commercial real estate values fell, threatening regional banks. Each indicator whispered caution, even as headline numbers projected strength. The Fed chose patience, but patience for policymakers often feels like pain for borrowers. Every day of delay compounded interest costs, extended financial stress, and narrowed choices for families. For investors, the message was equally complex. Easy money trades faded, while defensive strategies gained appeal. Dividend stocks, treasury bonds, and stable cash flows replaced speculative bets. The era of fast and free capital gave way to discipline and caution. Yet within this pressure lay opportunity, because higher rates rewarded savers, strengthened the dollar, and slowed reckless risk-taking. For those prepared, this period could build long-term financial resilience. The central question remained: how long could this balance hold? Economists split into camps, some predicting soft landings, others warning of delayed recessions. The yield curve stayed inverted, a historic signal of downturn. Global tensions, from energy shocks to geopolitical conflicts, added layers of uncertainty. In this fragile moment, Powell's steady hand aimed to protect the economy from its own excesses. But for millions, the cost of that protection felt immediate and personal. Parents delayed vacations, graduates postponed major purchases, entrepreneurs shelved ambitious plans. Each decision reflected the quiet power of interest rates. Yet understanding this moment revealed essential lessons. First, debt becomes dangerous when rates rise, making low leverage a powerful shield. Second, emergency savings transform from optional to essential in volatile times. Third, long-term planning beats short-term speculation when money is tight. Fourth, financial education becomes a survival tool, not a luxury. And finally, patience, discipline, and adaptability define success in uncertain economies. As history continues to unfold, the Fed's rate hold stands as a reminder that stability often demands sacrifice. Jerome Powell's calm exterior masks the gravity of choices that ripple across generations. For borrowers, the road ahead may feel heavy, but informed decisions can turn pressure into progress. For investors, clarity and caution can transform volatility into opportunity. For families, resilience and planning can soften even the hardest financial storms. The drama of the Fed's decision is not just about numbers and charts, it is about people, dreams, and futures shaped by a single rate choice. And as America watches the next meeting approach, one question echoes louder than ever. Will patience today protect prosperity tomorrow, or will prolonged high rates rewrite the financial destiny of an entire generation?